Just in the interest of time, I'll go ahead and begin to introduce the topic and my two panelists. I do have with me, looks like on my left, will be Bradley Kading from the Association of Bermuda Insurers and Reinsurers. He's president and executive director there. And on my right is Jack Nicholson, who's chief operating officer of the CAT Fund, the Florida Hurricane Catastrophe Fund. Our plan today is really to have an open discussion among the three of us, and primarily I'm anxious to hear Brad and Jack's ideas about the future of the CAT Fund. So we really want to focus today on thinking and taking the opportunity when the CAT Fund is really in the best financial condition that it's been in a number of years, to think about what we mean by right-sizing the CAT Fund. So thinking about size, which is both capacity and resources constrained. And then also, in addition to thinking about size, thinking about what elements there are to resources today that there may not have been in the past or may not have been in the abundance. You've got to be careful about using the word abundance, but may not have been available in the past the way that they are today. So looking at maybe new or more resources that are available to the CAT Fund, and also looking ahead at the general structure of the fund in addition to its size. So the plan that I have for today is I have some questions I would like to ask both Brad and Jack and get their responses to, and then hopefully we have time after that to open to the floor in case others in the audience have questions as well. If we don't get to that, I am hoping that the questions that I have are of interest to the audience and would have been some of the questions that you all would have asked. So I'll go ahead and begin from there. The first question I have is really directed to both gentlemen, and I'll let Brad start with a response and then Jack follow. But just in general, what do you view, Brad, should be the role of the CAT Fund to Florida specifically?
Thanks, Lori. I think it's appropriate to note I'm the only non-PhD on the panel, so special dispensation perhaps. And Lori, you didn't mention the great FSU report, which I think you were the primary author of, so congratulations to you on a great report. And Jack, congratulations on great stewardship of the CAT Fund along with Mother Nature, which has allowed you to build a great surplus. So the chief issues for us in the CAT Fund, it goes back to what we think are the legislative intent 20 years ago, the CAT Fund creators, would be for the CAT Fund to be something that provides stability to the Florida market. And what that means to us is a layer of dedicated reinsurance coverage that is there year in and year out. And when you calculate what that layer is, it sort of is a process that must include what is the debt financing capabilities, what is the track record, what is private market resources. But we would sort of envision the CAT Fund being a dedicated layer of, say, $10 billion, 10 maybe to $12 billion, that the CAT Fund's goal would be to make sure that that layer of coverage could be there for the first year, the second year, and the third year. And that then, with that stability in the market, removes a great deal of market risk, we think, and also reduces a degree of political risk in the market. So that's what we would say in summary is probably the goal. And of course, if that's implemented, it also then puts the deficit financing and the hurricane taxes that go with that into perspective and allows those issues also to be managed well.
Thanks, Brad. Jack, your perspective?
I think I'm going to probably say the same thing, maybe in a little different way. From the get-go, the CAT Fund has been for the purpose of creating additional capacity in the state and also maintaining that capacity. Brad touched on that. We do need to be able to pay for not only an initial season but subsequent seasons. I think what the challenge becomes, and certainly over time as the state grows, as exposure in the state has grown, and our capabilities, we become more and more risky as a financing mechanism. Now, what we do know about reinsurance is highly volatile over time. You do have a times of a great situation like it is today, there's, depending on whose numbers that you use, something like 550 or more billion of reinsurance capacity just in the traditional market, maybe another 45 billion in the what we call the non-traditional market. So it's a very healthy reinsurance market. Rates are very competitive and so forth. But that's not always the case. Some people, and I'm not old enough to remember Hurricane Andrew. I was only 5 years old at the time, but I've aged a lot since then. But some people remember that event, and some people also remember 2006 and what happened to the markets then. So that's not that far away in time for us to be sensitive to the volatilities of the market from the private reinsurance market standpoint. But what was kind of new to us is the volatility of the financial markets and the subprime crisis that happened in 2007, the very year that the CAT fund was extended by $12 billion. And I've told this story before, but I was riding in the back seat of a taxi in New York in August of 2007, and we were trying to talk to underwriters and investors about some pre-event notes in order to make sure that we could fund our capacity from a liquidity standpoint, and asking our financial advisor at the time, John Forney, and Ben Watkins in the front seat, I said, could we do $20 billion today if we had to? And they turned around and looked at me like I was totally out of my mind. And a chill came over my body at that time. You know, I'm thinking, well, wow, you know, we've had people buy $28 billion of CAT funds capacity, and a lot of that's dependent upon us going to the financial markets. And during that whole trip in August of 2007, we had a very hard time. You know, we visited California, we went to Minnesota, we went to New Jersey, New York, maybe some other place, but we had a very hard time finding people that wanted to talk to us because they were busy responding to the subprime crisis. We pulled out of the market, came back in October, and were able to finance $3.5 billion of debt. But the challenge remains one of managing risk. And we do have some tools. We're going to talk more about that today. I'll mention some things there. But I think the role of the CAT fund really hasn't changed from its main purpose, and that is to work with the private market. But we do have to recognize the risk in the private market as well as the risk in the CAT fund through the financial markets that we depend on. How do we create capacity? Basically by bonding. So I think that probably summarizes it.
Just an add-on question to that, Jack. You touched on the riskiness of the financial markets, the volatility of the markets, and certainly you touched on the riskiness of the CAT fund itself. If you were to say, in terms of right-sizing the CAT fund, that there was one focus point or one epicenter of focus, what would you say that is?
Well, I think no matter how you determine the size, it's only half of the problem. And the problem is volatility. And size creates volatility. And when you lower the size of the CAT fund, you allow for a wider range of options in managing the risk of the CAT fund, whether it be, if it's liquidity that you're concerned about, and we are concerned about that. When we do our bond estimates, we estimate both our capacity for 12 months and 24 months. Some people have criticized us for that, saying that, well, you know, why are you doing 12 months? You ought to do 3 years. Well, here's a news flash that some companies cannot last 2-3 months without getting totally reimbursed for their CAT fund coverage and other reinsurances that they may have given an event. A 1 in 20 event, maybe a 1 in 200 event for some companies, and not even trigger other companies, depending on where their risk is located throughout the state. So I think that we have to be very careful, but it all starts with the resources that you're going to pay claims with. We have cash, and we have the ability to issue debt. And what is the concern about that debt is the not only just trying to estimate it, but understanding that it can be volatile and it can change very quickly based on a number of financial factors that I don't think anybody really understands. I mean, it's hard enough to predict interest rate movement, and of course, interest rates are at the heart of trying to estimate capacity, but also access to the markets and investor attitudes and things like that. And a lot of that has changed since 2007. We have a wholly different perspective of a lot of risk analysts that they're buying securities. The bond insurance market, that we're municipal type debt, a lot of that went away, and there's still bond insurance, but it's not as abundant as it used to be. And when analysts look at debt, whether it be a cat fund or Alaska's debt or California's or New York's or Florida's, in the past they looked at a AAA rating and said, great, I don't have to do much analysis, it's all the same. Today, that's not the case. They do have to do an analysis, and to the extent that they understand the debt, they'll buy it, invest in it. To the extent that they don't understand it, they'll stay away from it. When you've got the name hurricane and catastrophe in your finance corporation, you do have a problem when those guys have to explain that to their management. Now, why did you buy this? We changed our name of the finance corporation last year to State Board of Administration Finance Corporation. So that was more to be realistic in terms of we are financed with premium revenue and all that. So anyway, I think it's a very difficult question, but it has to start with what kind of confidence do you have in the financial markets? How can that volatility affect you, and how can you manage that from a risk management standpoint with other tools, whether it be pre-event notes of some type, lines of credit, if they are available, which these things aren't always available in the time period that you want it. We also look at fixed debt and variable debt and evaluate that in the equation. Then we look at risk transfer products and whether that fits our needs and would do the job or not. So it's a multi-dimension question. It's not just picking a size, it's managing to whatever size you pick. And the smaller the size, the easier it is to manage to that.
Thanks. Brad, what's your perspective on really what the focus point, I mean, do you agree? Do you have difference of opinion there on what the focus point is in right-sizing the fund?
I think we're pretty encouraged. I think the lessons of the financial crisis probably paint the picture pretty clearly for policymakers and what the risks are and what a pathway may be to get to a right-sized cat fund. Again, the cat fund is there to augment capacity. It's not there to displace a large share of capacity, and in current market conditions make the point that the cat fund is displacing private sector capacity. If you're displacing private sector capacity, you're also camouflaging the cost of risk in Florida. It's not good for anybody to be camouflaging the cost of risk in Florida. I think the previous panel members spoke to that already. There should be price signals that are sent to make it clear that there's risky territory and that people need to be careful in citing residential property or citing businesses, protecting so we can keep people and property safer and control costs over the long run. The financial crisis, I think the lessons of that are for the last 7 years, that the cat fund insurers were mandated to buy a product from the cat fund, and it was questionable on whether the cat fund, in the case of a severe event, was going to be able to deliver on that promise. And so that's a key issue for policymakers in trying to figure out how to properly size the cat fund to match it with the bonding resources that are available and to match it with the other interests in the state. So when we look at that, we think sort of incrementally taking down top layers off of the current cat fund program, reducing the size from $17 billion in cover, maybe $1 billion off in each of successive years until you get to the level which allows you to spread out the bonding capacity over the 3-year period that I earlier described. So I think Senator Hayes' bill, Representative Hager's bill, does a good job of moving in that direction. So again, there's always going to be limited bonding capacity, and whether the financial markets are placing the limits on it or whether consumers are placing the limits on it. We need to understand that when debt gets issued, it has to be repaid, and consumers have paid now roughly $5.5 billion in financing costs for the 04-05 storms. And those bonds are finally paid off in 2016. So there's a couple more years of payments on that. And at some point, the political question is going to be, do businesses and auto customers want to continue paying for bond debt, which has not provided them a benefit? Only 27% of the deficit assessment base is from residential policies, which are the beneficiaries of the CAT fund. So again, if the political equation is not properly managed on the debt financing, you undercut political support for the financing itself, which then further compounds the problem of providing stability in the market. So I label that roughly as financial stewardship of the bonding resources, and they have to be viewed as scarce resources, and that should factor into the equation for policymakers.
Great. You both touched on something that I wanted to ask about next, and that is the estimated claims paying capacity. I think in one way or another, whether you use the phrase or not, you're touching on that issue. That is a big area of concern, I know, for CAT fund. From a managerial standpoint, it's also a big concern for participating policyholders in the CAT fund. And I'll start with Jack, and I'd like to hear from both of you on it. But do you think that estimates of claims paying capacity could be measured in better ways? Do you think the estimates could be done better? Do you think we can get more accurate with those estimates? Is that possible today?
Well, I'm not sure about that, but I think there's ways to manage. And let me give you a little bit of history so that you can kind of understand the problem a little better. When the CAT fund was created, there was language that was put in that said, you know, we were obligated to the extent of our cash balance, and that was created through an actuarially indicated premium that was charged to the companies based on their risk exposure. And then the other thing that obligated us was we were subject to an assessment. Today, it's 6% on an annual basis and 10% in the aggregate for all years. So we can assess to raise bonds. So what does the CAT fund promise? We promise all our cash and all that we can do bonding. And the statute read that way up until 1999. It still reads that way today. It hadn't changed. None of that has changed. But before 1999, and this hadn't changed either, is that we were required to estimate capacity twice a year because there was no number in the statute. Just as estimate it, tell us what it is. How did insurance companies know what CAT fund coverage they had? We had to tell them. So we had to get our underwriters to estimate that. We had a financial advisor. We generally, back then, if you looked at some of our estimates, and all this stuff is online on our bonding reports, we had a range of estimates based on interest rate volatility. What if interest rates go up 25 basis points, 50, 200, or go down? How would the capacity change? Now, we were tasked with publishing one number, so we published the number that was effective as of May or October at the time period when we had to estimate that. So that was and is the situation today. What changed in '99 didn't change that, but it did put a cap of $11 billion on the overall capacity. And that was a cap to limit capacity so that we could create subsequent season capacity and be able to recharge the CAT fund and have the CAT fund work in the long run, not be a one-storm wonder. Some of you may or may not remember, I know you remember Ray Muslin, but he wrote an article called Taming the Wildcats or something like that. But anyway, he talked about this problem of subsequent season. He was on our advisory council. He was a very good, effective lobbyist and helped articulate the problem of the CAT fund. So we were able to limit the capacity to $11 billion and get additional bonding authority, if you will, for subsequent season. So that situation was just enhanced in 2004 by changing that $11 billion to $15 billion, but it also upped the assessment authority to what it is today to be able to fund that. And that looked great. I mean, for a while there, everything was just super. The problem is that at the time you had a lot of investment banks and commercial banks interested in certain types of debt and hedging strategies and all this stuff with subprime and mortgages. You're all aware of that. But there was other things going on as well. And we had felt, and our financial advisor advised us this way, that there was an appetite for large issuance of the debt. And we perhaps could do as much as $25 billion. So yeah, okay, fine. And as we went on, we looked like we could not only fund an initial season, but a subsequent season as well, and maybe a third season. That all changed in the backseat of that cab in August of 2007, realizing how volatile the markets could be. So the problem became more difficult in estimating capacity because all we used to do was subtract the cash from that 11 billion or that 15 billion. We knew what our capacity was the initial season. We would publish that. Exactly the way we do it. Simple subtraction. A third grader could do it. Now, as the subprime crisis started to hit, we felt like it's not just a mechanical problem of cranking the numbers through and figuring out what we ought to be able to get, but we had to do another thing. And I motivated this with our financial advisor. I said, we have to go to the underwriters, and they have to go to their desk, and they have to ask a realistic question. How much could the CAT fund finance within the next year, within the next 6 months? We have to know a real number. And in the midst of the financial crisis, October of 2008, when we asked them to do that, they came back with $3 billion, which was a shock. We had other resources. We had $2.8 billion of pre-event notes. We had another 3.5 of 5-year notes. We bought a put option from Berkshire Hathaway for $4 billion. I'm not sure how good it would have done because we would have had no resources for a while before we had to trigger that up at $16 billion, and then we would have bought debt at 6.5% from Warren Buffett for $4 billion. So what I'm trying to do is to make you understand the difficulty, if not the impossibility, of estimating these numbers. They're highly volatile. I know Don Brown is sitting here. He's on our advisory council, and I sent out a note to our advisory council a couple years ago, and I was trying to address this issue, and I said one way to handle this is to put a cushion in there to recognize that volatility. Because the way I read the law, and I don't count because there's other people that are more important that read it, the insurance companies, OIR, but the law says insurers may use these estimates for all regulatory and reinsurance purposes. So I felt like, and I take it very seriously, the numbers that we publish, and I want to give them numbers that are realistic and something that they can rely on. And what I was concerned about is that although our FA had strong confidence in those numbers and our underwriters, we've had strong confidence in the past, and we've noticed potential shortfalls. I think the year before it was like $3.2 billion, and that kind of prompted us to come back and want to do some legislation to reduce the CAT fund. Because we felt that if insurance companies relied on our estimates, and those estimates happened to be wrong to their detriment, there could be a number of insolvencies in the insurance industry, and that was not the intent of the CAT fund, to create risk for the marketplace. It was to eliminate risk and provide additional capacity. So I think we still face a major challenge in that, to the extent that we can do pre-event notes, lines of credit, if and when they become available, take advantage of the right type of debt financing, whether it be fixed or variable rate debt. And if we look at risk transfer, I'm going to talk more about that in another question, but those are the type of things we can use to manage our risk and to mitigate some of these problems. I'm not so sure with the size of the CAT fund being what it is today that it is possible to eliminate risk other than to mitigate it. That's why bills like Hager's and Representative Hayes are very important. I thought that for the last couple of years, when those were somewhat in play, and they're in play this year, that is a very positive step in right-sizing the CAT fund and making it easier and maybe more feasible to to provide the capacity that insurance companies rely on. We want to be so that the cat fund coverage is a guarantee. A couple of years with no storms, the initial season may be a guarantee, but what does that say for a subsequent season? So we're still concerned about a subsequent season. I'd like to continue a dialogue along those lines and try to do the best we can to either fix or mitigate that problem. But it's not possible when you have a volatile financial market. And when I say that, don't think of today. Today makes it even worse if you have a lot of confidence. You have to look at historically what happens in financial markets. They do fall apart from time to time. They do have liquidity crises. You cannot count on them and guarantee that we'll have the funding that we need at the time that we need it. So you do have to make other plans. It's called managing your risk. Insurance companies do it all the time. Firms do it all the time. The states should do it. So I've kind of gone on and on about that, but that's all I got to say.
Wonder of wonders there. Okay. In terms of estimated claims paying capacity, Brad, I'm curious about your perspective on it, as well as looking at new capacity in reinsurance markets. And to the extent you want to respond to what Jack said, that's fine, but I'd also really be interested to hear your perspective on new capacity that's in the reinsurance markets and what you think that means or could mean to the cat fund.
Let me answer both questions, and just a short response to Jack's question on claims paying capacity. The cat fund is pretty transparent on the bonding estimates. They publish a good report. They publish what the individual underwriters that opined say is the available capacity, and there's a great range in that. So as a cat fund buyer or as a policymaker, I'd encourage you all to be quite familiar that the cat fund is selecting a bonding estimate, but from that there's a wide range of outcomes, and it really won't be clear until post-event what is really available. So it's probably time for the first actuarial joke of the panel. So there's an old, the bonding estimates remind me about actuarial projections. So the story of the two actuaries pheasant hunting, the pheasant is flushed, one actuary shoots to the left of the bird, one shoots to the right of the bird, they give each other the high five and say, "We got him." So they've framed the range of outcomes, and I think that's what Jack and his team are working with. There's a range of possible outcomes, and they have to choose a number. So it's best to be cautious and conservative in that estimate. With regard to reinsurance capacity, segueing to the next question, sometimes you wake up in the morning and the ground shifted the night before. So there was a fundamental change in reinsurance market capacity in March of 2013. So as a reinsurance underwriter, the CEOs now in their conference calls on earnings and in the other public forums, including the Insurance Information Institute's forum on Tuesday, it's pretty clear that the reinsurance executives think that something permanent has happened in terms of shifting the capital base going forward. And that capital base has been shifted in favor of consumers. That shift in favor of consumers creates an enormous opportunity for the cat fund as a reinsurance buyer itself and for policymakers in terms of right-sizing the cat fund in this current circumstance. So Florida, her reinsurance prices went down for property cat risk 15% last June 1. That's what sort of was being telegraphed during the legislative session. It actually happened on June 1. The rest of the world caught up on January 1 with 15% declines in reinsurance costs. And there's an expectation that there's going to be another adjustment downward on June 1 in Florida. So the expectation is that by June 1 in Florida, the cat reinsurance prices here will be back to pre-Katrina, Rita, and Wilma levels. So why has this happened? This has happened because pension funds primarily are now looking at catastrophe risk as a diversifying asset class. They've tested this risk for 20 years. And if you take 1% of the $1 trillion of pension fund assets available, you come up with $150 billion of potentially that could be invested in that scenario. That's a small amount of money to the capital markets. It's an enormous change in the capital available to reinsurers. Just an enormous change, a doubling of reinsurance capital. Excuse me, not a doubling, but by going up by 50% is what you could see in that equation. So the estimate is today that about $50 billion probably sits from these alternative investors in catastrophe reinsurance markets, and that by the end of the decade, that could well go up to $150 billion. So when the company execs say there's been a permanent shift in the capital or the financing that supports the reinsurance business, that's what they're looking at. And so the investors are willing to take an 8% return on their investment. The reinsurers had been looking for a double-digit return. So again, the market shifted. It's a buyer's market out there, and that is sort of the sense of the advantage that is presented to both insurers and the cat fund and policymakers in Florida. So we don't think. The sense is it's not a temporary, but it's something you should be designing your own risk management strategies around. Even having said that, looking at the property cat prices in Florida over the last 8 years, I think they've gone down for the last 8 years in any event. So it's an important market for reinsurers, and it's a market which has important benefits to consumers today. When we look at the opportunity for the cat fund to buy retrocessional protection, I think the experience of the California Earthquake Authority is informative. The CAA has been buying reinsurance for 17 years in a row. Its cost of reinsurance has dropped in half over the original charge to the California Earthquake Authority. It has grown its capital base 7 times while also purchasing reinsurance in each year. It's increased its purchase of reinsurance by more than 1/3 over that 17-year period, and still growing its capital base by 7-fold. So again, we'd encourage policymakers to, in addition to right-sizing the cat fund, to also think of the opportunity for the cat fund itself to buy reinsurance protection.
Jack, your perspective on that new capital capacity that's there in the reinsurance market?
I think, Brad did a great job of pinpointing and explaining, what is happening and the change in the marketplace and how dramatic that is. I think one of the concerns that we have had all along when the cat fund has looked at reinsurance, and we did try to buy reinsurance in 1999, unsuccessfully. Our advisory council voted against it, so we did not recommend it up to our trustees. But we were looking then at a product that was, it's no longer offered today, but it was the ideal product for what we needed, and that would have been a bonding shortfall product. So if we would have gone to the market and couldn't finance so much debt, it would have paid. And it wasn't a whole lot, but $300 million was more than a drop in the bucket, and the pricing was great at the time. But it was kind of dramatic on how people's attitudes changed back then, because we even had representative insurance companies standing up saying, the cat fund has no business buying reinsurance. What are you doing? So that tended to influence our advisory council against it. But the thing, as things evolve, I always like to say, we look at the products that come to the forefront. And I mentioned pre-event notes. There was the first pre-event note we bought was an extendable note where investors could get off the risk. Well, that didn't work too well. In August of 2007, the investment bank that sold us that product dropped its $500 million just like that. So 13 months later, it was gone. Everybody else fell in line. All that had disappeared. Kind of brought to mind that we need some permanency, not something that goes away when you need it. So I think that was a big mistake, even buying that particular product. So we went back and bought the $3.5 billion. That was a variable rate debt, 78 basis points above LIBOR for 5-year floating rate debt. It was 4 times the cost we wanted to pay for it, but instead of 78 points, it would have been 220 if we'd have waited 6 months later to buy it. So now it looks like a tremendous deal. All that has expired. So last year when we were looking at various products, fixed rate debt came to the forefront because we were in a historically low interest rate environment. And it took us a while to get our trustees convinced that we needed to do this thing, because you're walking in and saying, well, how much cash are you going to have next year? Well, 9.7 billion. And you want another $2 billion? No, sir, I'd like to have another $5 billion. That's how good the environment was. But it was going to have some carry cost to that debt because you do have to pay the interest charges on it and all that. At the same time, we had moved way down the road on making that decision. Then we had some reinsurance proposals come in, and I know some were presented before the House and the Senate, and I probably took a little bit of criticism for not, I guess we did consider those, but they did not fit the needs of the CAT fund. For one thing, legislation early in the session, Senator Hayes' legislation would have taken $1 billion off the top that year. Now, I didn't fall off a turnip truck yesterday, but I do know that if you get rid of $1 billion and you buy reinsurance for that $1 billion, you've just wasted your money. So I didn't know what the session was going to be in terms of that, but also I had some big concerns about how that would trigger and the probabilities at the top of the CAT fund. You have to understand that the probabilities of triggering that last $1 billion is a lot lower than what an industry loss at that level would be, because everybody in the CAT fund would have to exhaust the CAT fund coverage. And you do have some diversification over the state. Very unlikely for that to happen. So that was not attractive from that standpoint. But one of the bigger things and concerns was the terms and conditions of coverage like that. And what I was fully aware of is for traditional insurance, you get reimbursed on an indemnity basis, and we understand how it works and everything. For collateralized reinsurance, which we were looking at, which is very much like CAT bonds, it's the same type of investor involved, the pension funds and that sort of thing. But the conditions can be a little more restrictive, and I was very sensitive to that. I mean, Citizens has bought a CAT bond for the last several years and is looking at one today, but they buy it in the proper layer. So we know that how it triggers, how it works. Well, the CAT fund trying to buy collateralized reinsurance or a CAT bond at the top of the CAT fund, first of all, the commutation provisions when you settle up with the companies with the CAT fund is 5 years. I wasn't interested in talking to somebody about a 2-year commutation provision or paying more to extend that longer. And I know the type claims that we're going to get less because we're still paying. We had to do an emergency rule to extend commutation with one company. It's 2014. The commutation period ended 5 years past 2005, so it was in 2010, and we're still settling up those claims. So it wouldn't have done us any good for our last dollars through the door, where we know is going to be commercial residential claims, condos and all that have been litigated and that sort of thing. So certainly I had no appetite for the terms and conditions of that type of policy. But as Brad points out, with the competition that's going on right now, what we're finding is somewhat, and I don't want to say a merger, but there's somewhat a more liberaling of these terms and conditions, so that what I did several months ago was talk to our executive director as well as other people at management at the state board and said, look, we need to look at reinsurance and we need to look at some of these changes. I think we can get a product that would fit our needs as we define it. And we said, well, what is that, Jack? And I said, that's a product that fits right above our cash balance so that it avoids bonding as much as possible. And secondly, the terms and conditions are the same as what the CAT fund has to pay its participating insurers. There's no holes in the coverage. I don't want Swiss cheese. I want coverage that has no gaps, provides the same coverage that the law provides, as well as our contract. Brad refers to us as reinsurance, and I many times say we're like reinsurance, but I never say we're reinsurance because we're not. We're significantly different. The law governs what the CAT fund coverage is and how it operates and how we're funded. A lot of major differences there we're all aware of. But we do a similar function. So what we have decided to do is to go forward with this, but that's a process that involves our trustees' offices, getting them to approve it, probably going to a cabinet meeting for them to give us approval to go ahead. When would we like to do this? Yesterday would be my answer, because I would like to be on the street as soon as possible. There's money flowing in the system, as Brad mentioned. And I know Citizens is in the market right now. They're in the market at the right time. So I don't know if we'll be able to go at the February cabinet meeting, maybe the March, But that is all a call for the trustees' offices, and it's up to us to sell them on the idea that this would benefit the CAT fund. The pricing is reasonable. The impact on the CAT fund rates is reasonable. The impact on consumers will be reasonable. And what we're thinking about is, saying we'll authorize, up to maybe $1.5 billion at a certain price that we feel like is reasonable, so that we can walk away if we can't get that price, terms, and conditions. But we certainly want it to be realistic. And we think that when you think about things, this works similar to legislation, taking coverage off the top of the CAT fund. Whether we do it administratively or whether the legislature does it through law, it kind of works the same way. And another provision that's been liberalized is the ability to have multi-year coverage, not so much that we would be interested in attaching at the same layer every year, we would not, but we would be interested in moving the layer so that if we don't have any losses, we can move up with that reinsurance. If we do have losses, we can move down, and adjusting it on an after-the-fact manner, but having that opportunity. So I think that defines the type of reinsurance we're interested in, as well as the type of reinsurance we're not interested in, and the reason that we would want to pursue this product. There's three ways to go. There's catastrophe bonds, there's collateralized reinsurance, and there's traditional reinsurance. We're looking at something that meets our needs to the best. If I had to focus on any of those, it would be collateralized reinsurance at this point because of the simplicity compared to cat bonds, but I don't want to take those off the table. So we'll be looking at all of that, and we've got 3 reinsurance brokers ready and poised to go out in the market if they get the go-ahead from our trustees' office, and we get the go-ahead and so forth. But Aon Benfield, Guy Carpenter, and US Re are our brokers, and they have been pre-selected as part of our financial services team. And so that's pretty much the status of where we are with those types of products.
Okay. I think we're about out of time, and I appreciate the thoughtfulness of the answers. I had hoped to get one more question in there, and so I just want to give you both a chance to in conclusion, maybe 30 seconds, 30-second elevator speech, soundbite, and if you could include in 30 seconds or less what kind of legislation you're interested in supporting this year, that would be fantastic.
Okay, so here's my 30 seconds. We think Senator Hayes and Representative Hager's bill is a good approach. We would not support legislation that reduces the retention by $2 billion. The reduction of the retention simply compounds the volatility, compounds the risks that we've spent most of this time talking about. So reducing the retention increases the frequency of payout by about 28%, increases the frequency for instead of once every 9 years to once every 7 years, increases cross-subsidies in the market, further camouflages risks, and it would be a terrible long-term decision for the state.
That was fantastic.
Thank you.
That was fast. Jack, can you do that?
I'll try to. Anything that goes in the right direction in terms of shrinking the obligations of the CAT fund and is a positive. Anything that goes in the other direction is a negative. We want to be able to manage our risk. We want to be able to, like I said, guarantee coverage almost. I say that in quotes. I don't know if it's ever going to be possible, but certainly to make the CAT fund coverage more certain and more reliable to companies so they can depend on it and feel good about that, and it actually works. So I'm very hopeful that we can move in that direction. There's been some other ideas, and we've kind of clipped around the edges with the CAT fund administratively. For example, we've eliminated fine arts a number of years ago. In the last several years, we've looked at the collectible type properties, getting rid of coverage on $12 million wine cellars and wine and baseball card collections and things like that, filling that. That wasn't the intent of the legislature to insure that type of property. We're also looking now very carefully about, and there may be some proposals about eliminating homes above $2 million, getting rid of some of the high-valued, wealthy people's homes and concentrating more on the rest of the CAT fund. So those ideas have to be kind of flushed out, but I think anything that eliminates our risk, reduces our PML, makes our promise to pay more certain, is something that we would feel very good about as it passes at the end of the day, but we certainly wouldn't want to give away things that are very beneficial to the CAT fund, such as the cash buildup factor and other things that Brad mentioned.
Fantastic. Well, I want to thank you both for your participation and your thoughtful commentary today, and thank Mark and the Chamber for including this session. Thanks.
Thank you very much, and please join me in giving them a